All right, so deal financing, huh? That's pretty cool. If you're ready to jump into that world, you've come to the right place. Because today we're going to do a deep dive on how to, well, fund anything, pretty much.
That's right. And a lot of people I talk to, they kind of get stuck thinking about the same old ways to get financing.
Yeah, the usual suspects, right?
Exactly. But get this, there are tons of other options out there. This list we're looking at, it's amazing. Really creative ways to make deals happen.
All right, so let's break it down. I see loans and bonds and equity. But then there's royalty financing, convertible debt is a lot.
Yeah, it can be a little overwhelming, but think of it like this. We can group these methods into categories. Makes it easier to get our heads around. So you've got your traditional methods, that's your loans, bonds, equity, your foundation.
Gotcha, the tried and true. But then things start to get interesting with these alternative financing options. We're talking venture capital, crowdfunding. Sounds pretty different.
Totally. Alternative financing, that's where things get innovative. You've got venture capital and angel investors. They're usually backing those early stage companies, the ones that are growing really fast, especially in the tech world.
Right, right.
Crowdfunding, that's a fascinating one too. It's almost like the community invests in the idea.
Right, it's like people power.
Yeah, exactly. And then there's mezzanine financing. That's a kind of bridge between debt and equity. And asset-based lending, that's where you use your assets, whatever they are, as collateral to get a loan.
Hold on. Mezzanine financing. I've heard that term thrown around, but to be honest, I don't really know what it means.
So picture this. You've got a company, right? And they need more capital than a bank's willing to give them, but they're not quite ready to go public.
Okay, I'm following.
That's where mezzanine financing swoops in. It's higher risk for the lender, so they usually ask for higher interest rates. But the payoff could be huge if that company really takes off. High risk, high reward.
I see. So we've got traditional, we've got alternative, and then there's specialized financing. What makes them so well specialized?
Specialized financing, those are like the specialists, right? Tailor-made for particular situations. You've got project financing, that's big for infrastructure. Yeah. Think of huge projects like building a wind farm or a bridge.
Right. Big, complex projects.
Exactly. Then there's trade financing. That's all about keeping global trade moving. Letters of credit, export financing, that kind of thing.
Okay, starting to see the bigger picture now. There are a few methods here that I'm super curious about. Let's dive into royalty financing. How does that even work?
Okay, so think of it like this. You're a company with a hot new product, something you know is going to be big, but you need money to actually make it happen. An investor could give you the cash you need, but in exchange, they get a cut of your future sales, like a percentage of the revenue from that product.
So they're basically betting on your success. Interesting. Okay, What about convertible debt? That's huge with startups, right?
Absolutely. Convertible debt, it's a really smart way for startups to raise money, especially when they're still in those early stages, when it's tough to put a real value on the company.
Yeah.
So it starts as a loan, but here's the catch. Later on, it can be converted into equity.
Meaning ownership.
Exactly. And often at a discount. So the investor gets in at a good price, and the startup, they get a simpler fundraising process. It's a win-win.
Clever. All right, one more that caught my eye. Factoring. I know it has to do with selling receivables, but what's the real story there? What are the trade-offs?
Okay, so imagine you're a company, and you're waiting on a big payment from a client, but you need that cash now. You can sell that invoice, the receivable, to a factoring company.
So you get paid faster.
Exactly. You get the cash right away, even though the client hasn't paid you yet.
Sounds great, but there's got to be a downside.
There is. It can be pretty expensive, and some companies might think it makes them look, well, financially shaky.
Right, I see. Okay, last one, and this one always throws me for a loop. Sale and lease back. Why on earth would you sell something just to lease it back?
I know, it seems counterintuitive, but it's a way to unlock the capital that's tied up in your assets. Let's say you've got a company that owns all their buildings, right? And they need some serious cash for a big expansion. They could sell those buildings to an investor, but then immediately lease them back. So they're still operating in the same place, but now they've got a bunch of cash on hand.
Okay, that actually makes a lot of sense. So with all these options, how do you decide which one is right for you?
That's the million-dollar question, right? Honestly, there's no one right answer. It really depends on the deal, where the company is in their journey, how much risk they're comfortable with, what their long-term goals are. There are a lot of pieces to the puzzle.
So it's not just about the money, it's about strategy too.
Exactly. And don't forget, a lot of the most successful deals, they use a mix of different methods. You got to get creative, Find a solution that really fits the situation.
So think outside the box. Don't be afraid to get creative with deal financing.
That's it. And as you're figuring this all out, remember, the best deals often come from thinking differently, finding those creative ways to make it all work.
That's some great advice.
Yeah.
All right, everyone, if you need to dive deeper into any specific method, you know where to find us. Happy deal making.